Good morning, good Friday from Los Angeles. Markets are closed. Checking my microphone. Do you guys like my hat? Extra sauce. It has its own story, but we'll go on from there. It's going to be my favorite hat going forward for at least a week or two. Welcome to Power Hour. Markets are closed, but we have a lot to talk about. I have to get off a few things off my chest. We'll still go into some charts and give you guys my opinion of what I think is coming up. And but more importantly, I will have an interactive power hour today. So I will post the link when I'm done with my topics. There are a few topics that I want to talk about. We have had 100 days almost now of the new administration. Not a day goes by that it's not exciting. It's super exciting, really, especially if you're a trader or if you're involved in the markets. But more importantly, I'm constantly trying to read the tea leaves of what's going on and how it's going to affect my investments, short and long term. So, I'll answer the questions in a minute. But so welcome to Power Hour every Friday, 10 a.m. Pacific, 1 p.m. Eastern. Mondays, we have Trading with Sergio live during market hours is again 10 a.m. Pacific, 1 p.m. Eastern. And on Wednesdays, I do a members-only live stream. A lot of new members joined. Thank you for the support. If you're interested, just go click on the join and you'll be a member and you'll have access to a bunch of things. Most importantly, without being financial or trading advice, you have access to members only Telegram chat group where I post my trades live. There's a couple other channels running on YouTube with full transparency. I appreciate them. I'm trying to run it with full transparency, wins, losses, gains. But the most important thing I'm trying to do is when it comes to trading, especially teach you guys how to fish, because there is a strategy for each occasion. And it seems like the strategy is continuously changing when it comes to how the markets are behaving and what I'm supposed to do with it. The volatility, please go check it out. Last Power Hour of 2024, I put out my predictions. There was one prediction that has been the reality for these 3 months already. Well, we're into April 15th. Tax day is gone. In 3.5 months, there is one thing that I said at the end of 2024 that's holding true. Increased volatility, and it's going to stick around. Now, increased volatility is a good thing for me. It gives me more chances to trade, but then at some point, even that makes me uncomfortable because it is so high that the pricing of everything I do as far as derivatives are concerned are obviously going with VIX, with volatility index, but you have to be really, really careful. This is when, if you don't have experience and if you really don't know what you're doing, you can really blow an account super easily. For example, if you had short position on the day President Trump announced 90-day delay on tariffs, you would have gotten your face ripped off. That account would be blown. So, I've talked about it quite a bit. I talk to my members all the time. Keep cash around all the time. Keep your sizing correct. Yes, you can get lucky and buy 0 DTEs or whatever and makes tons of money. Look, it's possible. I'm not saying it's not, but I'm just trying to survive this year. Hopefully get a positive return in a negative market environment. But there are reasons for that. Why are the reasons for that? The reasons are pretty simple. The reasons are there is a push and pull going on between the Fed and the current administration. I'm going to talk about that. Bond market is really telling a different story than what stocks are telling. A lot of tea leaves to read this year, and I'm glad I've seen this movie before. Comparatively, this is very close to 2008 with different circumstances. In 2008, obviously, we had a real estate bubble that burst, and we know what happened. It took a year and a half of downside of over 50%, and it took multi-years to come out of it. Now, are we back in a lost decade again, starting 2020? We're in 2025. I'm going to talk about that. There's a gentleman I respect quite a bit. I follow him religiously. I think he's brilliant, but I'll talk about my views of lost decade. And if you do go back in a couple of months or 3 months, whatever, watch the last episode of Power Hour, we talked about that. We talked about the lost decade, and you know, the first 5 years starting 2020, it's happened to be pretty accurate on stocks and bonds, actually. But we'll talk about those things. So without further ado, let me get into my topics. I'll put the post, I'll put the link, I'll post the link for a StreamYard. If anybody want to come on and talk to me about things, whatever they want to talk about, I'll be more than happy to do so in a minute. So initially, what I want to talk about, 4 or 5 topics, and the last topic, I think you guys should stick around. We're going to talk about the 2 elementary kids going at it in a schoolyard. You're going to say, what's the analogy? Well, you guys will figure it out in a minute. About a month and a half ago, I talked about everybody being in the pool. Okay. In fact, I posted it with a thumbnail of everybody having a great time having drinks in the pool, beautiful day. What happens when everybody gets in a pool, and who is in the pool, right? So for decades now, U.S. has been the guiding light of the globe when it comes to investing, when it comes to liquidity, when it comes to product choices. Money has been pouring into the U.S. and that so all the people who are in the pool, we are in the pool as long-term investors and retirement accounts and pension plans and hedge funds and, more importantly, foreigners, right? What they did is, they did have the trade deficits going with the U.S., but then they, in turn, turned around and invested in the U.S., those dollars. Since dollar is the world's reserve currency, what better place to invest your money, long or short term, in dollar-denominated assets, such as stocks, such as bonds? Well, that's been going on for a while. And one of the reasons the volatility has picked up is not because of what the administration is doing with tariffs and everything else, is because there's a lot of selling going on. So people ask me about this quite a bit. It goes like, why do stocks go up? Why do stocks go down? I mean, I put it as simply as I can. And some people say, oh, come on, it's better than that. It's not as simple as that. No, it is as simple as that. It's supply and demand. It's tomatoes and potatoes, man. When there's more sellers than buyers, the price needs to get adjusted down. When there's more buyers than sellers, the price needs to get adjusted up. That's how stocks move. Now, you can look into the fundamentals, the technicals, and macro, micro. Yeah, you can do all those things, but simply put, stocks or indexes that are attached to these stocks, which is the S&P 500, they move up and down due to supply and demand. If there is too much supply, price needs to get adjusted down, and that's what's been happening. So the beautiful bull markets that we enjoyed in bond and stock markets from when we had ZIRP, right, zero interest rate policy, that ended in 2020 when inflation came around, right? But then everybody kept investing in the U.S. because we are the golden child of the globe. Okay, we buy more than these people, China's and Europe's and Vietnam's and Japan's and Korea's, and what they do. They come and invest in the U.S. How'd they invest? They invest through bonds. They come and buy our treasury bonds. They come in and buy our stocks because we have the best companies in the world. We do. There is no ifs and buts about it. Yes, we don't manufacture anything, but what we have in turn is we have technology. We have information technology. We have amazing companies in the U.S., such as NVIDIA, such as Google's and whatever not. But the point I'm trying to make is that money seems like now it's trying to find an exit. And when that happens, and I'm going to put up a slide in a minute to see the magnitude of that. When everybody's in a pool, there's nobody else to come in the pool. So what happens? What if there's a shark in the pool that nobody's seeing? And well, that's what we've been experiencing now over the last, I don't know, month and a half or so. Is it permanent? Probably not. But is it going to be? Has it damaged a lot of accounts and a lot of retirement accounts? And if this exodus is going to continue, because it's pretty clear what's happening in stocks and bonds, that there's an exodus from dollar-denominated assets. Well, here we go. So I do follow the Coinbase letter on Twitter, on X. Why do I keep saying Twitter? On X. And so it's pretty simple, man. Numbers don't lie. So foreign investors are dumping U.S. stocks at a rapid pace. Well, they got in the pool. Everybody's in the pool. Investors from overseas withdrew $6.5 billion from U.S. equity funds over the last week. This is just a single week. And that's when it comes to the supply and demand issue, right? When it comes to stocks and bonds. This is the second largest amount on record. Net outflows were only below $7.5 billion seen during the March 2023 banking crisis. According to Apollo, which follows these stats, foreigners own a massive, are you guys ready for this? 18.5 trillion of U.S. stocks, or 20% of the U.S. equity market, right? So I'm going to connect this to when I talk about the two kids in the schoolyard, fighting. There is a connection to this, right? But hold your horses on that one. So 18.5 trillion, or 20% of the U.S. equity markets, are owned by foreigners. Why? Because they trusted the U.S. They trusted the system. They came and invested their dollars that they earned through trade, let's say. That's a different story. Fair trade and unfair trade, all that stuff is completely different subject. But they at least returned the money to the U.S. and U.S. companies, and through corporate bonds or equity investments, private equity, whatever it may be, saw the benefit of that. So yes, we did ship the money out. We shipped the dollars out, but the dollars were returned right back to the U.S. in investments. Moreover, foreign holdings of U.S. treasuries, okay, I did a really cool video called "Who's Holding the Bag of 37 trillion in IOUs that we have to issue because of our national debt." They own 7.2 trillion, or about 30% of the total. So they have a $7.2 trillion treasury holdings. They have 18.5 trillion. These are T's, people. By the way, U.S. equity market is worth about 100 trillion. Okay, well, it's got cut a little bit by about 10 trillion now with what we had, 10% or 15% drawdown that we had. So combined, about 25 trillion plus dollars in U.S. investments. Okay. Do you guys, I mean, last week was only 6.5 billion that was liquidated. We're talking trillions of dollars. Now, is all of this going to leave the U.S.? Absolutely not. What's going to happen, though, is that, when we do put tariffs on these countries and they have U.S. not denominated assets, that's their gun. They may just, get out. Now, you're going to say, Serge, nobody's going to do that. Dollar is still the reserve currency of the planet. And I get it. I don't think dollar is going to be deserted as the U.S. or the reserve currency of the globe, but they are holding some weapons now. $25 trillion is a lot. Investors from abroad also hold the total 30% of the total corporate credit market. Now, 30% of the treasuries, which is bonds, notes, bills, whatever it is, 30% of the corporate credit market, because corporate bonds are a massive, multi-trillion-dollar marketplace. So foreign investors won out amid the volatility. Well, not just the volatility, and as you guys can see with the circle on the right-hand slide, now this may indicate a short-term bottom, right? But as you guys can see, the jaggedness of this chart. Look where we were right before the elections. We were, again, this is not political. Everybody was in the pool. Now everybody's trying to get out of the pool. This is like, being in a small room with 100 people and yelling fire, and there's only one door to exit. Well, that's why we're getting the drawdowns. That's why we're getting the volatility in the stock and bond markets. People are trying to get out. As we know, a lot of people are on leverage as well. So they're trying to, clean up leverage. And I get it. But $25 trillion is invested in the US. And it doesn't seem like the new administration has a clear plan of how to work this. And I'm going to talk about this again with the two kids in a schoolyard analogy at the end. I hope they have a plan, because I cannot fathom what would happen to markets, bonds, and stocks if foreign investors decide to take their money away. And that's another thing that's happening, that the US dollar is getting weaker, right? So because these are dollar-denominated assets, what has to happen? They have to sell these assets. Once they sell these assets, they have to convert, to their own currency, such as euros and yuans and yen and whatever you want to call it. Well, dollars are being sold. This is complete opposite of what the administration is trying to do. From the first day, they talked about, we need a strong dollar, we need lower interest rates, all that good stuff. Well, none of that is going to happen if the foreigners start, keep liquidating these assets. And I mean, talk about supply and demand shock, right? Billions and billions of assets are being liquidated. And where is the money going? I'm going to talk about that subject in a second as well. But one of the main reasons for this, okay, when the administration took over, now, one thing that the administration is doing, or President Trump is doing, that he said he was going to do, he's not doing anything different than he said he was going to do. He said tariffs, 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 tariffs. He said that during the campaign. And I think in the market, ignored it. They just looked at it as noise. They may have looked at it as, it's just a threat. When he does take over, if he takes over, if he wins the elections, he's not going to do any of that. Well, not only he's doing it, he's just doing it like to nobody's expectations, right? So on that part, maybe the market was not ready. I mean, I don't know. But the one thing that he's trying to do, that he's seeing quite a bit of pushback, is lower interest rates, okay? I've talked about this quite often. Who needs lower interest rates the most? Okay, the consumer does, obviously, right? Because our mortgages depend on it, our auto loans depend on it, our credit card balances depend on it. But more importantly, the U.S. government needs lower interest rates. We have $37 trillion in national debt. All that $37 trillion is borrowed money, IOUs, sent out to the world. Just like on the first segment, I said 30% of our treasuries are owned by foreigners. Who are these people? Japanese are the largest holders, over $1.2 trillion. The Chinese used to be the largest. They're cutting exposure on a weekly basis, right? They're selling the U.S. bonds that they hold. Well, so there is a problem here, though, right? The problem is the administration wants lower interest rates. On the other hand, they're putting tariffs on, which will be inflationary. There is a group of people under the guidance of Chairman Powell of the Federal Reserve. They're not listening. And one person that Trump cannot fire at the moment, unless he finds a way of doing it, is Jay Powell. Okay, we won't talk about that, but there is this standoff going on. And oddly enough, President Trump, during his last presidency before Biden, he was the one that appointed Chairman Powell as the head of the Federal Reserve. Now they're at odds. The Federal Reserve is saying, look, we're data dependent. We have a mandate, 2% inflation, full employment. We're not there. Tariffs are going to be inflationary. We can't cut interest rates. If we cut rates, inflation is going to come roaring back. But the Trump administration says, no, we need lower interest rates. You can't have both. You can't have low inflation with low interest rates unless we're going to go in a very deep recession here. right? And that's the other thing stock market's kind of sniffing now, because stock market was setting itself up for a soft landing, which is never, I mean, it's been done maybe once, half-ass. It's a very difficult thing to do. So that's completely discounted. Now I believe the stock market is pricing in a slowdown. When they price in a recession, we're going to get the next leg down. But during a recession, interest rates automatically go down because demand for money goes down, and that's the gas pedal that the Federal Reserve has. Lowering interest rates, they can, pump some money into the economy and then get it going again. But this back and forth that we're experiencing, right, between President Trump and the Federal Reserve, specifically Jay Powell, I mean, there is a lot going on. There's a lot of back and forth going on, right? President Trump accuses Fed Chair Powell of playing politics. I don't think he is. I think he was appointed. If anything, he should be supportive of Trump, right? But I think they're doing the right thing because Fed is in a box. We've had a broken fiscal policy for so long that Washington has this tax and spend attitude, right? $2.5 trillion of debt every year we're borrowing to get, to put it into the economy. We're living on borrowed money. We're living on borrowed time. That'll be the equal of you maxing out all your credit cards, except that nobody else is going to give you credit. Our advantage is we can create dollars out of thin air. And the return on those dollars, borrowed dollars, is nothing now. It's less than 45 cents on the dollar. It used to be 4-1, right? So this madness has to end. So the Trump administration is raising tariffs, which will be inflationary due to supply chain constraints, okay, on the American consumer. But on the other hand, they go, well, we need lower interest rates. Well, President Trump, it doesn't go together. It doesn't work like that. I mean, I'm sure President Trump has some intelligent people, such as Scott Bessent and other people around him who are ex-Wall Streeters who understand the dynamics of this. You cannot have lower interest rates with high inflation. Well, what's also happening is that I talked about this a couple of months ago, stagflation, right? That word, honest to God, 4 months ago, I did a video. Nobody was talking about stagflation. Well, everybody's talking about stagflation today. All the talking heads on CNBC are talking about stagflation now. Stagflation, we don't want. Inflation, we can't handle. Deflation, we can't handle. Stagflation, there's no cure for that. That's bad, okay? That's as bad as it gets. So President Trump is saying Europe is cutting rates, but our guy wants to play cute. Okay, President Trump, I don't think you're an economist. I don't think you understand what's going on here. But to me, I think the Fed's in a box. They're following a broken fiscal policy with their monetary policy. Their mandate is 2% inflation with full employment. We can't have both. We can't have a roaring economy with low interest rates. Just can't. We can't have tariffs, very high tariffs, which is going to be inflationary ultimately. And we cut interest rates. That's going to get the inflation just roaring, the fire roaring. Trump also says Powell is terrible and Fed officials are not very smart. I mean, I get it. I get what's happening here, right? We have a little Mexican standoff going on. And President Trump says Fed Chair Powell will leave if he asks him to, and adds that he's not happy with him. You're not, but the guy is doing his job. Fed's neutral, should be neutral, right? Feds should just be in the business of regulating the pace of growth in this country. If it gets too hot, they raise rates, slow down the economy. If it gets too cold, we get in a recession, they lower rates. That's their job. Their job, they have a mandate. Their mandate has been set for decades. It has nothing to do with Trump or Jay Powell. Their mandate is low inflation with high employment, period. Well, we don't have low inflation. Inflation is sticking around. Now, a lot of people blame Jay Powell and the Fed to bring us here. Well, I don't think so. I think what happened is the black swan event took place called, the pandemic, and we printed $7 trillion and pumped it into the economy. One thing I agree with, I have called the Fed, I have blamed the Fed for being behind the curve. Yes, I think they let them loose monetary policy, observe zero interest rate policy for too long. And inflation genie got out of the box. Now they can't put it back in the box. And another thing is President Trump says Fed Chair Powell termination cannot come fast enough. Okay, well, you can't fire him unless there is some law that you guys are going to pass. And he tweeted, the ECB is expected to cut rates for the 7th time. Why, President Trump? Because the economy is slowing down. And he put the tariffs on in the U.S.'s economy is about to go in a recession. He said recession odds are going through the roof. And yet, too late, Jerome Powell of the Fed, who is always too late and wrong in capitals, yesterday issued a report which was another untypical complete mess. Oil prices are down. Yes, why are they down? Because we're going in a recession. That's why it's down. Groceries, even eggs, are down, and the USA is getting rich on tariffs. I have breaking news here, man. The tariffs we're going to issue are, one, going to be inflationary. Two, at best, is going to bring in a few $100 billion. Due to this uncertainty, the stock market just lost close to 10 trillion and bond market just lost close to $10 trillion in wealth. I have breaking news here. People do not spend money on how much money they have in the bank. The US consumer spends money on how rich they feel. When they get their 401k statements or when they get their brokerage statements, see that the account got decimated by 30-40%, they're going to pull back. President Trump, I mean, look, I voted for President Trump, but I'm going like now, I'm not questioning it. I think what they're doing is honorable, but I think they're taking a massive risk, and I think they're doing it too fast, too soon. But that remains to be seen. So too late, should have lowered interest rates. We can't lower interest rates. We can't. We're in a box. We put ourselves in a box by issuing these IOUs of $37 trillion. We brought ourselves here. I've been talking about this since I started the channel. We brought ourselves here. We made our bed. We need to sleep in it now. Because if we do lower interest rates now, which actually I have a trade for lower interest rates, which I'll discuss in a minute. And I do believe rates are going to go down. But they're going to go down not because we want them to go down. They're going to go down because we're going to go in a recession shortly. And that's what I think is going to happen. So I don't understand this back and forth that's going on between the administration and the Federal Reserve. Federal Reserve has a mandate. They have to follow that mandate. That mandate is data dependent. Federal Reserve is not going to cut rates because President Trump wants lower interest rates. And the person that needs the most lower interest rates is the U.S. government. It's because of our $37 trillion in debt, which 9 or 10 trillion of that is coming due now this year. They're going to mature those IOUs we issued with zero interest rate or close to it, 10, 20 years ago. Well, now rates are 4.5%. Okay. On the long end, well, now we're going to issue bonds at 4.5%. The servicing of that 37 trillion is going to cost us a lot more than it did when we first issued those bonds. So you guys have to understand who wants lower interest rates. The U.S. government needs lower interest rates the most. But on one hand, you have a policy that through tariffs, inflation could get lit up again, which is not going anywhere. Or what the best scenario that I see that's going to happen in this is we go in a recession, consumer pulls back, inflation gets decimated just because we're in a recession, because that's what happens. And then we get lower interest rates due to that. But it's not going to happen because some person wants lower interest rates. It's just not going to happen that way. And so, yeah, I don't know. I think we're in a box here. Especially Jerome Powell and the Fed are in a box. Maybe there is a way for President Trump to fire Jay Powell, but I don't know. I think actually Jay Powell is doing a decent job. I'm not a huge fan. I think they were behind the curve a couple times. There are parts of that argument that I agree with President Trump, but then lower interest rates and tariffs don't go together. Tariffs are inflationary. Lower interest rates are more inflationary. Loose monetary policy is more inflationary. And the only way I see out of this is just a natural progression of economics. We go in a recession, consumer pulls back, inflation goes down, because look, the simple definition of inflation is too many dollars chasing too few goods. You don't have to be an economist to figure that out. And we have that. We had that for almost 2 decades, right? With zero interest rate policy. So yes, I do agree they kept it too long. Yes, I agree they were behind the curve raising rates. But I think that's going to be the natural progression. But just because somebody wants interest rates, things don't work out like that. And because the interest rate market, the bond market, is a lot larger than anybody can control. And just like on the first segment I mentioned, 30% of our bonds is held by foreigners. And 20% of the corporate bonds are owned by foreigners. So, yeah, good luck on that. But talking about Jay Powell, he had an amazing, wonderful, that's probably the best interview that I've seen for a while. It was funny. It was poignant. Please go check it out. He had, I think it was Chicago Business Bureau. He had an interview, about half-hour interview. I watched the whole thing. I highly recommend all of you go watch it. I mean, the person that was asking the questions asked some really funny, cool questions. But one of the questions, so I'm on Twitter, right? I have all these fin twits. They go, "Oh my God, market's crashing." What? Market's down 10% or 12% on the S&P and 15% on NASDAQ, and market's crashing? We just gave back what we got last year. Not sure. But that's because all these people have not seen a bear market, or they haven't seen a recession. All they know is markets only go up. Stonks only go up. New high, new all-time high, 50 of them last year, 55 of them the year before. People, stonks don't only go up. Stonks only also go down. And when they do go down, they take the express elevator down. They make sure of that. But going back to this interview, that was a poignant time. Because as we know, everybody, all these youngsters, right? They're all expecting, oh, there's a Fed put, there's a Trump put. They're not going to let the market crash. They're not. I kind of agree with that. But I think their put is a lot lower than where we are at the moment. So this gentleman who was an economist was asking Jay Powell questions. And I was like, okay. It was really, really great interview. Please go watch it. Yes, it had something to do with economics. It had something to do with his personal life, what he does, when he's relaxing, Jay Powell. Wonderful, wonderful questions, right? And I enjoyed it thoroughly, so please go check it out. But one of the questions directly was asked, Fed Chair Powell, will the Fed intervene if the stock market plummets? Straight up. And I was like, man, that guy has balls to ask him the question. And I'm now thinking, Jay Powell he's usually what he does is he dances around these types of direct questions, right? Which is expected because he moves. By the way, during that, this was on Thursday, the second the news reading algos got a hold of the statement that he's going to read, and we have these things, right? There's news algos that read the news within 1 millisecond. By the time you're done with the first sentence of the news release, they have already read it and they're trading already, right? So that's what you guys are up against, all these day traders, right? They go like, oh, a day trade. I'm like, yeah, good luck with that. By the time you read first sentence, they're already shorting spiders or futures. And the market tanked on Thursday, right? Okay, so the question to that is, will the Fed intervene, which is the Fed put, right? We've had that in the past. We had that in the 2008 crisis. We had that in the, during the pandemic. Fed put meaning, I mean, they won't directly go buy stocks, but what they'll do is they'll just release billions and trillions of dollars into the marketplace, create liquidity. So other banks and hedge funds and whoever investors are, they can, come stabilize the marketplace. So the Fed put, so basically it was asked, is there a Fed put? Is the Fed going to allow the markets to plummet? His response, no. The second he said that, the futures tanked another 10 handles. And I was like, wow. Because I had never heard in the last 5 years Chairman Powell commit to an answer like that. He goes, no, with an explanation. The market is functioning as it should, even though there are many uncertainties. Wonderful answer. So all the FinTwits on Twitter were like, oh my God, there is no Fed put. I'm like, just because your portfolio, high beta portfolio is down 40%, you think Fed cares about your portfolio? You know, if you bought some Palantir at like $120 and it's 75, who cares? Fed doesn't care about that. But what Fed should care about is recessions, the mandate. So this was amazing, right? He goes, no. And the market is functioning as it should. And the market is functioning as it should. The market is pricing in a slowdown now. Market hasn't started pricing in a recession yet. But there's a lot of talk that's going on. Like the recession odds in 2025 are up to like 55, 60% now, which was zero, okay? The timing of these comments is particularly important to note. Yes, it is, because he has this little tiff going on with President Trump. And President Trump is saying, lower the interest rates. Powell going, nope. Where's the Fed put? Like I said at the start, I think the Fed put is a lot lower on SPX than here. A lot lower. And when is that going to be? When I put up the charts, not that the charts are meaning anything these days. But my reading of the tea leaves with all this is that we have only given up less, actually, than what we gained in 2024. And that was done with hocus pocus, smoke and mirrors. Pump, pump, pump. Put trillions into the economy. Push, push, push. Assets go up. Hard assets, all hard assets going up. Real estate, new high. Gold, new high. Stocks, new high. Money has to go somewhere to get a return. Where did it go? Well, it went into stocks, right? Okay, so we're just not even giving up what we got in 2024. And all these FinTwits on Twitter and Facebook and YouTube, they're all like, oh my God, world's coming to an end. I'm like, no. And what the Fed Chairman Powell said, I agree. Markets are functioning the way they should. Stock market is the best pricing mechanism on the planet. Best. Sometimes it overshoots. Sometimes it undershoots. But now we'll have 2 quarters at least of headwinds coming up. What are those? Earnings coming up now. A lot of companies are going to pull guidance. They're going to go, nah, we don't know. We have uncertainty. And markets are functioning perfectly well. Yes, the volatility is crazy, right? We're moving 4 or 5% every day, which is not normal, which will subside over, maybe a couple of weeks, couple of months period. But this is what we have. I don't think the Fed should intervene. Why should the Fed intervene? Okay, maybe we'll give up what we earned in what the indexes, went up by, I don't know, 25% 2 years in a row. Okay, maybe we'll give that up. What's so bad about that? We could just go back to 2023. It gives a lot of people who are going to be new investors a chance to DCA, dollar cost average, into markets or stocks that they want to own. But if you're holding a high beta portfolio and you're not hedging, or you did not hedge, and we know what happens to high beta stocks. When the market goes down 10%, your stock is going to go down 30% if you're a 3 beta portfolio. Don't be crying, Stocks only don't go up. So I'm a fan of gold. I'm a fan of Bitcoin. By the way, Bitcoin, with all this stuff, holding itself here about 85,000, I think is definitely showing its true colors now. Gold, new high every day. Gold is going up like we're in a depression, but there's reasons for that. The reasons are attached to the first segment that I talked about. What are foreigners doing? What are they doing? They're getting rid of their dollar-denominated assets. Where is the money going? To gold, to hard assets, right? Okay, well, gold, I think, is like 3,300 now, 32, 3,300, okay? Well, here are the numbers. Gold is trading like we're in a depression. I don't think we're in a depression. I think we're going to be allowed to go in a depression. Over the last 20 years, gold is now outperforming stocks, up 620%, compared to 580% gain in the S&P 500. Now, that I wouldn't have believed, but this last spike that we're experiencing is pretty crazy. Over the last 9 months, gold has officially surged by over $1,000 an ounce. Why is this happening? The gold market's saying that inflation is not going anywhere because gold is a reasonably good inflation hedge. Bitcoin, I think, is a reasonably good inflation hedge. And if you had told me, Sergio, we're going to go an SPX from 6,100 to 4,800, where is Bitcoin going to be? And this sell-off is going to start when Bitcoin was at 90,000. I would have lost that bet. I would have said for sure we're going to be at 60,000 or less on Bitcoin. Not so. Holding our, holding ourselves together here at 85. So, is the next leg up coming in Bitcoin as well, just like gold? Time will tell. But I'm a bull on Bitcoin. As you guys know, I've been talking about it. I like Bitcoin. I like a dollar cost average. A little bit here, a little bit there, all the time. So what is gold telling us? Well, this is what's happening to gold as well. You guys recall in the first segment, I talked about foreigners getting rid of dollar-denominated assets, right? That's where the money is going. Specifically, China. What is China doing? Okay, China's holdings of gold and U.S. treasuries have moved in complete opposite directions. Look what's happened. Look at that chart on the right-hand side. Okay, the yellow line that was flat and took off, right? Going to the upper right-hand corner is gold. The white line going the other direction is their U.S. Treasury holdings. They used to hold 1.3, 1.4 trillion. They're down to about 650 billion in U.S. Treasuries that they're holding. Well, they're getting out. The other reason they're selling treasuries is to protect the yuan, because they don't want devaluation of the yuan, right? So they're just selling dollars to keep their currency afloat. And I'll talk about that again, stay tuned. I'll talk about those two kids in the schoolyard having a little tiff going. China's holdings of gold and U.S. treasuries are moving in different directions. And that's true. And that's what's happening around the globe, too, by the way. This is not just China. A lot of foreign governments, are getting rid of dollar-denominated assets. Again, some of you may say, is the U.S. still going to be the reserve currency of the world? Absolutely. But like I said in the first segment, there's 30%, 20% of U.S. stocks up to 18.5 trillion is owned by foreigners, and 30% of our treasuries are owned by foreigners. We may have just seen the tip of the iceberg. They're getting rid of it. What are they buying? They're buying gold. Well, I don't know. Is it the right thing to do? Is it the wrong thing to do? Is it for you the right thing to step into gold now after it's gone up $1,000 an ounce? Probably not. But I think these types of things, right, trends, don't end overnight. Although it seems a little parabolic to me, it seems a little, trees don't grow to the sky type of a thing for me, but pullbacks, you have a clear trend. The world is getting rid of U.S. denominated assets, U.S. dollar denominated assets, getting into gold. That's a lot of money going into gold. And the time that gold will stop going up is going to be the time that gold decides tomorrow, if President Trump says no more tariffs, we're just kidding, which we know is not going to happen, gold will tank probably by $500, right? But at the moment, and bond will rally, and U.S. dollar will rally, and gold will tank. But at the moment, starting with China, everybody in the globe, again, remember everybody in the pool? Now it seems like everybody is getting close to being in the pool in gold. Well, that's what's happening. The U.S. dollar is losing its trust due to what's happening, due to uncertainty created by the administration's decisions. And people go, well, I don't want my money in U.S. dollars anymore. Number one, it's losing value. Number two, we have uncertainty. Number three, we don't know. Gold at least is a store of value. And that's what's happening. So I cannot speak highly enough of this gentleman. Actually, to be perfectly honest, we were both born in the same country, Turkey, or Türkiye. His name is Cem Karsan. Okay, that's the Turkish pronunciation of his name. He's a brilliant man, and he still, is on the Chicago Board of Option Exchange. He has created multiple companies, sold them. You want to listen to anybody about Greeks, about option Greeks, obviously, about volatility, about anything, just go follow him on Twitter. He has, I think, a YouTube channel too now. His name is Jem Carson. So Jem has been talking about, a lot of Americans call it Chem. So his name is Jem. But long story short, he's been talking about the lost decade. Okay. And he started talking about this in 2020. He goes, this is going to be a lost decade. And he on this last pullback, by the way, he was like, to the day, he was accurate. I do listen to everything he says because I respect his opinion. But besides that, his knowledge, his experience, right? So he's been talking about this lost decade in U.S. stocks and U.S. bonds. Okay. He says stagflation actually has been around since 2020. Okay. And I started talking about stagflation about 4 or 5 months ago. But now everybody's talking about stagflation. So I think it's the most Googled word now on Google search. So stagflation is stagnant economy with high inflation. And that's what it seems like we're going into. Well, we are in one. The only reason we didn't go in one earlier with the true definition of it is because of loose monetary policy, low interest rates over all these years, right? So what's worse? Okay, what's worse than inflation? He goes, stagflation. Absolutely. Inflation we can control. How do we control inflation? Raise interest rates, which we did, 0 to 5.5%. Albeit behind the curve a little bit. We did. Okay. So this is his Twitter handle, Jam Croissant, but his name is Jem Carson. He goes, breaks down his thesis on stagflation and why we may be entering a lost decade. A structural shift that echoes the 1970s, but with even more complexity. I 100% agree with Jem on this. I think we are in the lost decade because I'll look at the charts with you guys after this segment. And lost decade meaning stocks don't go anywhere, bonds don't go anywhere. And we'll look at the bonds and we'll look at stocks, where we've been, where we are. And let's see if you guys agree. If you guys agree, great. If you don't agree, sure. I'll put the link up in a minute and you guys can come on and talk about it with me. So lost decade. Well, lost decade means asset prices, with the exception of gold, obviously, or Bitcoin, right? The most liquid or major, held asset classes. What are they? Stocks and bonds. Bonds being much larger than stocks. They haven't done anything since actually 2020. Because if you look at where the stocks were at 2020, right? The high, and then we had the correction, and then we came back up, made a new high. Well, we're giving up what we got last year. Maybe we'll give up, according to Jem, we're going to give up what we got the year before as well. So we're back to square one. Yes, there's opportunities in all of this for traders. Investors, not much. If you've been DCAing into, indexes, which I highly recommend over a longer period of time, that does wonders. But do I agree with Jem about lost decade in bonds and stocks starting with 2020? Yeah. And again, my prediction for this year, except outside high volatility, people have short memories. Most people got involved in stocks or bonds or options in 2020 during the pandemic. We're all stuck in our house, government sending us money. We open a Robinhood account, we swing some options, make some money. We think everything is great. Wonderful. None of these new Robinhood YOLOers, FOMOers, hodlers, all the stuff that has come around since the pandemic, they haven't experienced a recession, true recession. They've experienced a couple of shocks like the Japanese yen carry, trade crisis. We had the higher 0 to 5.5 interest rates increased at the Fed, started in 2020 because the inflation is getting too hot. We had that. But a true recession has not taken place since 2008. Pandemic is a black swan event. It was like a sharp 50% drop and a V bottom. But that's all, and everybody is used to buying the dip and making money, Well, I think in 2008, if you go study history, it's not that far back. I'm not going back to the dot-com bubble because that was a different story altogether. But just study what happened in 2008. Study how long it took for the market to go down and how long it took to recover to new highs. It took years. And now, yeah, well, I don't think we're going to crash. I mean, we may end up going down 40, 50% from our highs. We may get down to 4,000 in SPX. Okay, we're down 30, 40%. Well, that's your lost decade. And then within this lost decade, though, there will be ridiculous rallies and ridiculous pullbacks. With increased volatility, I'm expecting that. And I'm hoping I'm sticking around and making some good money with all that volatility that's presented to me. So, yeah, lost decade. If you're DCAing, dollar cost averaging, yes, you may have a lost decade. But if you're young enough and you have a longer term horizon, there is no lost decade, man. You keep DCAing, and then you will come way ahead, way ahead. And so here's my last one. I started talking about two kids in a schoolyard, okay, elementary schoolyard, playing with fire. Who are these two kids? You guys guessed probably, right? It's the U.S. and China. Okay, all right. So we have these two kids. That's the best analogy I could come up with. In the schoolyard, you know, they're going at it, but they can't hurt each other that much, right? Elementary school, but they go, "My dad is bigger than your dad. My dad's going to come beat your dad up." And then the other kid goes, "No, I'm going to bring my brother and my dad, and they're both going to kick your dad's ass." Right? That's where we are with this trade thing, with this tariff thing going on, right? One day we issue 100%. China comes back with 110. Oh, now we're at 145. China goes, "Screw you, 160. Does it mean anything? Does any of this mean anything to anyone? Honestly? Is this how we're running? Are we trying to create this global economic nuclear war? Is this what we're doing? I think that's what we're doing. And here they are. Here are the two kids in the elementary schoolyard. "Hey, man, my gun is bigger than your gun." China goes, "No, screw you, up yours. I own 650 billion in treasuries. I'm going to dump the treasuries, spike your interest rates." It's happening, people. Look at the bond market every night. Every night I watch the bond market. Bond market gets a spike exactly at the same time of the night. What's happening? Japan is dumping U.S. treasuries. China is dumping U.S. treasuries. Foreigners are dumping U.S. treasuries. What happens when people sell something? Remember what I said about supply and demand? When those bonds are sold, interest rates go up. So in the bond market, interest rates go up and down inverse to the price of the bond. When you sell something, the price goes down, interest rates are going up. China goes, "Oh, you put tariffs on me? Okay, I'm going to spike your interest rates." So I'm looking at this. Besides now it's getting to be, okay, we're going in a gunfight with a 9mm now? Because look, if we didn't have this 37 trillion in national debt, all great. Would be like, I'm the boss. You play my rules, my way or the highway. That's what Trump is still saying, but I think he's a little delusional at the moment. He's going like, no, you're going to come kneeling to me. I'm the king. And the Xi goes, "Really? You think so? Let me spike your interest rates. Let me sell." What happens if Japan keeps selling treasuries? That has to get absorbed. Oh, not only that, now we have 10 trillion in bonds and notes coming due this year. Imagine what happens. We need to sell these bonds because that IOUs is not going to get wiped out. We have to replace these bonds. They're coming to maturity. We have to put 5-6% interest rates on these things. What happens to the servicing of that debt? Goes into 1.5 trillion, 2 trillion a year. Do you guys understand what's happening here? We're going in a gunfight with a 9mm. In fact, if this was 10, 15, 20 years ago, before our debt was 37 trillion, we had the bazooka. We go like, no, you need me. I'm buying your shit. I'm keeping your economy afloat. You listen to me. My way or the highway. Now, with 37 trillion in debt, the world holding 10 trillion in our debt and saying, really? I'll tank your debt. I'll increase your interest rate. I'll spike your interest rate overnight to 8% by selling your bonds. And we're going like, no, that's not going to happen. You still need me. You have to come to me. I'm going like, no, man, we're going in a gunfight with a 9mm while the adversaries are holding a bazooka now. We used to hold a bazooka. Now they hold a bazooka because we can't do this pissing race thing. Seriously, we're creating like this economic nuclear war. We can't play this game. Now, my next concern is we squeeze China because we are squeezing them, right? We're going to tank their economy. If we don't buy shit from them, what happens to their local economies? You think they're going to be able to sell enough to Europe and other countries, Russia, whatever? No, we're their major buyer. We're their bread and butter. If we don't buy enough, what happens? Hurts everyone. U.S. consumer gets killed. Inflation goes through the roof. Look, I don't understand what the Trump administration is trying to do. Bring back manufacturing jobs. Bro, we can't build factories in like 6 months. Most of them are going to be deployed or employees are going to be not human. They're going to be robots mostly anyway. So I'm going like, we need to stop here. Okay, enough, kids. Like, we need the teacher to come and separate these two kids. I don't know who the teacher is going to be, but we need to go like, okay, before like we're really doing some serious structural damage, because they're holding the bazooka. They have the assets. They start selling treasuries, spike our rates 8-10%. It's bad. So we need cooler heads to prevail here. Seriously. This childish thing, 120%, up 150%, up 240%. No. We need to end this. Because seriously, market's going to crash. Now, I don't care, honestly, but I'm more interested in the structural damage that we can create here. And that structural damage cannot be fixed overnight by just saying, okay, we'll just no more tariffs. We're doing some serious damage to our institutions. We're doing some serious damage to, structural damage to our bond markets. We need to stop here. Enough stupidity, enough madness. These two kids need to get separated, and the teacher needs to come in and say, hey, man, come sit down here. Let's talk about this. But yeah, going in a gunfight with a 9mm while the other side is holding a bazooka is not a good thing, man. I hope the administration understands this, and again, I commend their efforts of cutting fraud, cutting waste, cutting all. I get it. I got all that. But if we didn't have this, 37 trillion in debt, it will be a lot easier. Well, now we have all these IOUs. We're their bitch. We put ourselves here. We made the bed. We're sleeping in it. So that's it. So kids, stop. Go away. Let somebody else talk about this. But that's it. Yeah, that's power hour for you guys today. I squeezed it in an hour, which is good. So let's see who's here. Techie B, hello. Z Patch Made says buying SSO. I don't know what that is. I'll take a look. What would the bubble be this time? 2008, there was a clear reason. Yes, this is a good comment right there. What would the bubble be? The bubble's already been created, my man. And yes, DCAing over 10, 15, 20 years under the S&P 500, without a question. But the pain is huge in between. The bubble already is here. The bubble has been created, has been pumped up to this level with this 37, borrow and spend attitude. We can't keep doing that. Javi, hello. Do you think TLT could have a quick upward move if something breaks in the economy? Actually, TLT is moving the wrong direction now. You remember what I talked about the last segment between the two schoolyard kids, right? They have the treasuries. They're dumping the treasuries. They're controlling our fate, man. Because of the 37 trillion in debt, we need to issue 10 trillion of IOUs this year. Because the other ones are maturing with much lower interest rates. So you understand where the game is at? They can sell the treasuries that they hold, sell the dollar-denominated bonds, spike our rates, force us to reissue these bonds with 7, 8, 10% interest rates. TLT should be moving up now because the economy is definitely slowing down. TLT definitely. I mean, I have a trade on. Would that mean if it would be better to dollar cost average? It doesn't matter down or up when you're dollar cost averaging. You just dollar cost average, just like I've been doing with Bitcoin. I bought Bitcoin 6 years ago. I didn't do anything, but starting this year, I started DCAing every week. I buy like $100 worth of Bitcoin. Doesn't make any difference. If your horizon is 10, 15, 20 years, absolutely. Who cares if it's a new all-time high or a new all-time low? If you're thinking like that, that means DCA is not for you. You're trying to trade or time the market. Okay, I have this advice for you, Z-Patch made. Time spent in the market is a lot more valuable. With all the ups and downs, time spent in the market is a lot more valuable than time spent timing the market. DCA means dollar cost average. Every month, every week, whatever you can put away, you buy it at whatever the price is at the same time of the day. Period. Over 10, 15, 20 years, you will do beautifully. All right, headline. Trump wants Powell out of Fed. Yeah, we talked about that. Yeah, I know about that guy. Okay, that's too much. I'm going to boot you now. Good morning, Madam Mike. No. He can't fire him. He can't get fired. He's the only guy he cannot fire. I mean, he can push him out somehow. Maybe he's got some dirt on him or something. I don't know. Because he's not doing anything wrong. He's following the rules. He's following the Fed mandate. He's 2% inflation, full employment. He's not doing anything wrong. Fed's just stuck in a box because of the shitty fiscal policy we have. Monetary policy follows fiscal policy. If you keep borrowing money and spending it without having it to the tune of 2-3 trillion a year, what is Fed going to do? Fed has to issue bonds. Fed has to issue notes. Fed has to replace those bonds when they mature. That's what the Fed is doing. But Fed is looking at, if we got rates now, because President Trump wants it, he's throwing a fit saying, cut the rates. I'm like, bro, cutting the rates is not your problem. Inflation is your problem. And you put the tariffs on, which are inflationary. I mean, the guy is not, so I think I support actually Powell in all this. Yes, you got political. With the market conditions, would it be better to see into? No, just DCA into VOO, DCA into SPY, DCA into Triple Q if you want aggressive, DCA into IWM if you want growth stocks, or Russell 2000. There's a lot of indexes with very low cost you can DCA into. Very, very easily done. I wouldn't do specific stocks because, like, let's say NVIDIA or Google or Mag 7, let's say. Why would you DCA into those? Those things are moving 40, 50%. Because you don't know. I mean, if earnings are going backwards now for the next 2 quarters, or if we're going to a recession, those stocks are going to get cut in half again. Just DCA into an index. That's what I would do. Oh my God, look who's here. Good morning, Kim. Are you investing? Are you DCAing? You have any questions? You want to come on the show? Manny P, good morning. Okay, so I'm going to remove this, add this, and here's the chart. You guys can see this, put a thumbs up, please. Let me go through the charts, and then here's the link if you guys want to come on. Here's the link. I'll be right back. Hold your horses. Here's the link. You guys are going to come on, chat a little bit, shoot the shit. Market's closed. We're not doing anything. There's the StreamYard link. And here's the chart. We added it. What else do we do? Okay, here we go. All right, give me a minute. I'll be right back. Okay, folks, back at the ranch. All right, so this is the SPY, S&P 500, 1 year, 1 day. Let me see if any of you want to come on. Do you guys want to come on? No? Yes, somebody wants to come on. Yeah, give me a minute. I'll put you on in a minute. Oh, no, nobody wants to come on. Okay, well, there's the link. If you guys want to come on, you're more than welcome to. Let's go through the charts real quick. Markets closed, obviously. So we had a massive drawdown, well, decent drawdown, 613 to 480. That's about 130 points. It's about 20% on the SPY. However, remember the lost decade I talked about? Okay, let's look at that. Let's look at the lost decade. Let's look at the decade of 10 years. This is 10 years, what the SPY has done over the last decade. This is 2021 high, okay? So it started in 2020 with the rates going up, right? This is the pandemic right here. When the 50% drove down in the pandemic, and then we just shoot up. Okay, so our high is about 475, 480 in 2020. When inflation reared its ugly head and Fed started raising rates, okay? So obviously we went from 475 down to 350, which is about 35%, normal correction, not whatever, bear market, whatever you want to call it. And then we had this massive rally. By what? Smoke and mirrors, pump, right? So now we're back to the old high. Remember the lost decade I talked about? So we're back to 2021 highs at 480. Yeah, will we get down to about 400? Of course, if we go in a recession. And then we'll have a rip-roaring rally from maybe 380, 400 to 500, and then back down. And that's your lost decade, people. So Jem and I agree on the lost decade. And here are the bonds. Going back, TLTs, the bonds. There's your lost decade, people. This goes back 10 years. Bonds are actually, interest rates are higher. If you were holding bonds going back 10 years, you're actually losing money, right? And this is the zero interest policy period. This is 2019. This is 2020. Actually, if you're holding bonds since 2020, you're losing money because Fed raised the rates, right? When Fed raises rates, bond prices go down. That's why I have my TLT trade on now. Actually, I'm going to pull back more on the bonds. I'm going to go back monthly. Look where the bonds are. Okay, bonds are in 2002. Bonds were 81. The TLT was, because this is a direct inverse indicator on interest rates. So when TLT is going down, interest rates are going up. When TLT is going up, interest rates are going down. Okay, so bonds are back to where they were actually 22 years ago. So if you're holding bonds with 6 or 7% inflation eating into your dollar buying power, bonds have been a horrible investment actually. And that's why gold is doing what it's doing. That's why real estate's done what it's done. Hard assets. That's why Bitcoin has done what it's done. Here's gold going back 10 years. Look where gold is, right? Gold in 2004, $41 an ounce. Think about it. We're at, well, this is GLD, so $410 an ounce. We're at 3,100. Well, there you go, right? And gold also does have dead periods, like this period right here. You know, during the GFC, right? We hit a high of about 1,800, and then it took us on another decade, literally, to make a new high, right? But yeah, I mean, there are lost decades in every asset class. You just got to make sure that you read the tea leaves correctly and position yourself correctly. You know, let's look at the Mag 7 and then I'll go back. So let's not kid ourselves. The lost decade in bonds and stocks have been here, not that they are here. Yes, within that, things move. Things move sharply, aggressively. And okay, so let it be. And this is 3-year 1 day. So I'm going to stick with 3 years. This is 3-year gold, but let's stick with SPY of 3 years and 1 day. This is 3 years. Okay, so we're back to where we were a year ago. And then we'll lose another 15, 20% if we go in a recession. We'll be back to where we were in, I don't know, 2019, 2020. I don't see much wrong with that. Here's the triple Q. Same thing. You know, people go, oh my God, the world's coming to an end. Well, why? Because market went from 540 to 400. I mean, yeah, a big correction, but again, honestly, I'm not sure. Here's Apple. Okay, look at Apple. Where is Apple? Apple is 196. It's pretty much the same thing as it was in September, October of 2024, 2023, actually. And if you pull back some more, I mean, you know, Amazon, same thing. We're just giving up all we gained last year, so let's not panic yet. Google, right? Okay. What else? Tesla. Tesla's back to where it was. I don't know. I mean, if you've been holding Tesla, well, let's look at Tesla for a much longer period. This is 3 years. Let's look at 10 years. Here's Tesla. Tesla in 2021 was exactly the same price as it is today. Yeah, it had like massive gyrations. Again, stocks are to be bought and sold. Stocks are not to be bought and held. If you've been holding Tesla since 2021, you're exactly even. Okay, case closed. And same thing with, actually, this is a better way to look at it. This is Apple. Here's Apple. Okay. Apple is up in 2021. Apple was about 125, 130, and now we're at 190. Okay, there you go. This is triple Qs. Okay, in 2021, triple Qs were about 400, and we got down to 400, and we're at 444. All right, well, see, the last decade. That's why stocks are to be bought and sold. Stocks are not to be bought and held forever. However, you know, going back to that gentleman's question, over super long periods of time. Now, I'm talking very long periods of time, decades, okay? If you're young enough and you have enough that much life in you, look at this, okay? This goes back to 1999. S&P 500 in 1999, $44. Oh, a triple Q. And let's look at SPX. Here's SPX, 1962. Literally $2, and today we're at 6,000. Let's not go back that far. Let's not get crazy. Let's look at 1990, you know, to the last correction that we had. Let's look at 2008 correction. 2008 correction, SPX 652 low. We're at 6,000. Okay, there you go. Long periods of time. There are decades that are lost right here. This part right here that I'm circling, that started in 1999. That was the lost decade. You know, the dot-com bubble, right? We went from 1570, 1550 down to about 750. That's 50%. Then we went back up to 1550. Okay, talk about the lost decade. Then we had the 08 GFC, financial crisis. Then we went back down to 600 from 1500. And there's your lost decade. Is it going to, and then we had this ridiculous, wonderful run because we just printed and printed and printed and printed. Well, now there's your lost decade, potentially, right? You know, things need to catch up. Maybe the structural change is a good thing that we're experiencing. So overall, to me, stocks are to be bought and sold. I do trade quite a bit. And if you're a member or follow me or whatever, I have a reasonably good, you know, hold on what's happening now. And I think it's going to be a good year. My account's still up close to 35% for the year. Trading account, investment account, I started buying 6 stocks. I have, actually, let me put those charts up for you guys. Actually, yeah, let's do that. Let's look at it on a really long-term basis. I have Unity software. I'm buying it right about here, 19 to 21 range. Used to be a $210 stock. I like the company. I think it's a turnaround. Nike, I started buying about 52, 53. We're at 55. See, if you own Nike and you go like, oh, Nike is great. I'm like, yeah, cool. In 2017, it's trading where it was in 2015, actually, 16, 15. Okay, there you go. If you bought Nike at 150, 160, 140, 130, 120, 110, it's 50 to 55. This is Nike, people. Okay, the Nike you guys know, all right? So stocks are to be bought and held. No, stocks are to be bought and sold. Okay. Buying Kava, my long-term investment account. This is a newer kind of issue. I had bought it in the mid-30s, sold it at 155 after a year and 6 months or 5 months. Now I'm getting back in the 80s. I bought some at 82. I'm going to accumulate it. Then I'm buying SoFi. I bought it actually last week. Got lucky. Paid about 8.5. This is SoFi going back forever. I bought some at 8.5. I'm going to keep buying it in that under 10 range. I think long term it'll be okay. This is the long-term investment account. Okay. Everybody should have two: a long-term investment account and a trading account. My trading account is 6 figures, decent size account, but that's completely different animal than investing. Another one, I like Robinhood quite a bit. It's expensive, but I think they're going to be the best asset manager or best brokerage in the country. I'm not buying Robinhood itself. I'm buying something called ROBN, which is the 2x ETF of Robinhood. I paid maybe like 7 for it, 7.5. These are shares I'm buying. I am trading these in the trading account through derivatives called options. And last but not least, I'm buying some Soxel in my investment account. There is Soxel. Soxel is 2x ETF. It goes off of SOXX. Okay? All right. Well, look where it's at. We're back to 2021. There's your lost decade in SOX, semiconductor index, where everything in the country is run by. So things are to be bought and sold, not to be fallen in love, not to have emotional attachment to stocks. I hear a lot of YouTubers go, "Oh, I love this." Okay, why do you love this? You love Tesla? Okay. If you had Tesla since 2021, you didn't make a penny, while the market has gone up 3x. Now, if you had Tesla since 2019, different story altogether. But 2021 to 2020 actually to 2025 is 5 years. Your money's just sitting there, dead money. Did it rally to 500? You just sell it. No, you're not going to sell it. You think Tesla is $10 trillion company? Good luck. I mean, I love Tesla, don't get me wrong, but I trade. I'm not going to just because they go, oh, they have this coming, they have that coming. Whatever. Good luck. You know, I'm older than most, so I don't have that much time to dick around with. I will trade it though. Oh, NVIDIA. Max 7. There's NVIDIA. Man, if you own NVIDIA since 2021, 2022, you did amazing, right? Wonderful. Well, now, okay. I mean, it's back to its 2024 price. Everybody's crying, oh my God, NVIDIA's down 50, 30%. I'm like, so? Okay. I don't know. There's Palantir. Look at that thing, right? There's your, at some point, right? You need to, I mean, if you bought this thing at 10, 20, and you're looking at 125 and you think it's going to go to 500. I mean, I was shorting Palantir actually, but I'm like, you need your head examined. Okay. Stocks are to be bought and sold because 5x, 10x are not given to you every other day. That's a generational, once in a lifetime thing. Anyway, so if you guys have any other questions, the other guy said SSO. What's SSO? Pro shares. Yeah. Okay, cool. You know, it's like UPRO. Cool. No problem. VOO is another one. So if you're going dollar cost average into these things, IWM. There's IWM. That's the Russell 2000. There's many things to dollar cost average into. But what's impressing me more is Bitcoin. This is the BlackRock Bitcoin ETF. Man, it's not going down. It's not going down. You know what I mean? And there's MSTR, MicroStrategy. That's not going down. Right? This is 10-year, but if, you know, I mean, look at MicroStrategy and look at, you know, from 2021 and look at Tesla. Where are we at? MicroStrategy, $50. Now it's $300. It went up to $550. Tesla is the same price as 2021. So, you know, to each their own. They read the tea leaves differently than me, probably. But, you know, if you are following me, you know all about this, so I don't need to get into it in detail. Maybe some of you are willing to come on. If not, I'm gonna say goodbye and go do some other stuff today, because I have the day for myself is supposed to be a, you know, junkie today. Well, here we are. TLT trade again. Okay. Javi says, wouldn't the midterm elections limit the negotiation power? Well, G is in a very difficult spot. Okay. I mean, we are definitely playing this game of chicken here. The problem the administration has, why do you guys think they did this from the get-go? Immediately. Because it's time sensitive. If shit's falling apart, we're in a recession. By the time midterm comes, the Republicans are going to lose the Senate and the House. And when they do that, then all that agenda is out the window. That's when probably market will rally, actually. Xi, on the other hand, I'm hoping I'm saying his name correctly, is in a tough spot. Their economy was already in shambles, okay, local economy. The real estate market is in shambles. And they're pumping like crazy. I do like a lot of Chinese stocks, by the way, Baba and Billy and JD and Baidu and whatever. The stimulus is coming through fire hoses in China, but I don't think it'll be enough. So if you ask me who has the more holding power, is it Trump all the way to midterm and, you know, bring China to its knees? China saying, no, I'm holding the bazooka. I'm going to sell every goddamn treasury asset I have, and then spike your rate. So when you're, you know, when you're replacing your maturing bonds at 7%, you know, your carrying costs are going to be 2 trillion as opposed to 1.2 trillion. We're playing a dangerous game here. There's no winner here. I mean, the losers are going to be the average American. There's no winners here. So, yeah, I'm not liking what I'm seeing. All right. Hey, here's one of my members. What's happening?
Hey, Sergio. So I was looking at your, again, the TLT trade, and I understand the call debit spread, which makes sense to me.
Mm-hmm.
So if you're, I would say, kind of bullish that it's going to go up, why do you have the short at the 85? I'm just trying to understand the logic.
To finance the debit spread.
Oh, okay. So basically, there's no money out of your pocket. It's just
actually they're paying me to play. They're paying me to wait until March 2026.
Okay.
Okay. So let's look at the scenario. So for some of you who may not know, you can go to my YouTube community page. And did I freeze? No. Okay. You can go to my YouTube community page. All my trades are posted Monday, Wednesday, Friday. You'll see exactly what I've done. So with TLT, I believe interest rates are going to go to 3.5%, 3% maybe in the 20-year and the 10-year. 3% is equal to 110 on TLT. There's a reason I picked those strike prices. So what I did is, and I just showed you guys a 30-year chart going back to 2022, actually 23-year chart of TLT. TLT in 2021, 2002 was 81, right, Mike?
Right.
Okay. All right. So I'm selling the 85 put, buying the 95 call, and selling the 110 call, because at 3%, I think TLT will be 110. So that's the max I see TLT going, right? So I'm taking in money. I'm buying the 95 call. That's the spread side, 95 to 110. But I'm also seeing TLT not going below 80. Right? I'm not seeing the 10-year and 20-year interest rates not going above 5.5%. Right? If it does, we'll have much bigger problems. And the trade will be a loser. I got it. But I'm not seeing, with a slowing economy, interest rates are spiking unless China's bazooka is so big that they're going to go crash the bond market, which will be temporary anyway. That's why I did the 2026. So by selling the 85 put, three things can happen. In March 2026, TLT is 85. What happens? Everything expires worthless. Correct?
Correct.
85 puts expire worthless. 95 calls expire worthless. 110 calls expire worthless. Right? However, I am doing it with a credit. So that's my gain. Not big, because on the buying power that I have at the moment that I'm putting out to put this trade on, it's going to be about 22, 23% for the year, which is fine. Okay? Two things. Second thing, TLT is, I don't know, 95. What happens? Everything expires worthless again, right? But in the meantime, on its way to 95, that trade is going to be worth something. So when I'm putting the trade on with a credit to the put side, which it is now because it's closer to 85, and that, TLT moves to slowly, hopefully, to 88, 90, 93, 95, and I have 6-8 months to go on this trade still, because that's why I'm giving myself this time with the leaps. That is going to be, I can close that trade with a massive credit to the call side now, because calls are going to be more expensive than the puts that I'm selling. I am doing this with a credit. As long as I can do it with a credit, I'm going to keep doing it. I'm going to keep adding. The second it goes into debit, I will stop adding. I will just enjoy the position. I'm getting paid to play for a year. I already took their money. I'm sitting on it. As long as TLT does not go below 81, 82, I'm okay. And I'm also okay owning TLT shares in March of 2026 at 81, 82. Period. That's the whole idea behind it.
Okay.
Now, it's going to cost about $1,500 to do one contract, right? So at the moment, that trade is about 2.5 credit. So 1,500, meaning selling the 85, buying the 95, selling the 110, $1,500 we're tying up on buying power in our account. I'm taking in $250 for it. That's about 18, 20%-ish or something like that, 15, 20%, right? I did as high as 4. I did as low as 2.5. I will not add too much if it's less than 2.5 credit. But if TLT on Monday goes to 86, then I can put it on 3.5. Then I'll do it on 3.5 credit. As long as I'm doing it with credit, I'm okay. That's the whole idea behind it. You could do the call spread by itself.
Yeah, that's what I was thinking. I mean,
That's like $2. I think it's $2 debit.
Yeah, it was $2 debit, and I was like, well, I think the rates, the yields are going to go up or are going to come down, and therefore TLT goes up.
Yeah.
Chances are, because of the $10 trillion that actually needs to be refinanced. So the likelihood of, again, I know, like you said, there's big bazookas out there that could spike the yield.
Well, it's happening every night, man. I can see every night bonds are being sold by the billions. And when that selling pressure comes, price needs to get adjusted. And the price gets adjusted, rates spike, the next morning things come back to normal.
So how do you see that? So if I wanted to see bonds being sold, where would I look?
You got to look at the futures prices overnight. I mean, futures on the US 30-year, you can see the futures, right? June futures or September futures. If you have the quote, you see the price going down. When the price is going down, so bonds are inverse to yields. So if bond prices go down, yields are going up. When bond prices are going up, yields are going down. Same as TLT. When TLT is going down, yields are going up. When TLT is going up, yields are going down. So you can see it. And I mean, my whole thing is, like, as I said, like, this would be all good, the game we're playing now, if we didn't have that 37 trillion in debt. It would be great. It'd be like, we're at the point of power here. We're on top of the hill here. Yeah, you can't touch me. But now we have these things floating out there, man. We have trillions of dollars of these things floating out there. And, imagine Korea, China, Japan, Russia, England, Germany, they come together. They go, oh, you want to put tariffs on me? Okay, I'm going to spike your interest rates up, you bitch. I'm going to just sell those bonds, spike it up every time you're about to put a new bond out. Because look, by the way, you have to issue these bonds. It's not like, oh, let me just delay it a little bit, or you're going to default. There's 10 trillion coming up to reissue. There is no ifs and buts about that in 2025. Okay? You can't go like, let me just delay this a little bit. Or let me wait for Doge to cut this shit down so our deficit goes. It's not going to happen. It doesn't work that way. We need to issue these bonds. So every time we issue these bonds, what if the night before the auction, because Fed holds auctions, they do a concerted effort and they spike our rates? They can do it. Because we're desperate. We need to issue these IOUs. We have to. So there is a different game being played here. Very interesting game. Very dangerous game. I'm telling you, I hope those two kids go sit down. The teacher comes around. They go, hey man, enough is enough. Separate. Because this is not cool, right? Just because you have such an ego in Washington doesn't mean that you need to do this. And the other guy over there has the ego, and this guy has the ego, and they go like, hey man, but the problem that Trump has is like that comment, midterm elections are coming up. You have finite amount of time to make this a success. You know what I'm saying? We can't go in a recession here. We're going to recession, midterm elections. I don't think you can sugarcoat it and sell it. Recession is a recession, man. Everybody's going to get hurt. So I don't know. I know, but I'm hoping none of this happens. And tomorrow they all go, all right, let's just kiss and make up. Enough of this bullshit. And then we're all back to normal. But the longer this lasts, the longer structural damage is going to take place. And we don't want that. So, and I see the rates definitely going down. One way or the other. I have like four things. Four different scenarios. 3 out of 4 are beneficial for this trade. And when I have a trade like that 75% of the odds are in my favor, I'm going to step on it. Right? 1, we go in a recession. What happens when in a recession? Interest rates go down. Slow down. Interest rates go down. We control, Doge controls our deficits. Deficits don't go up. Interest rates automatically go down, right? Because we don't have to issue more bonds and we don't have to issue more IOUs, right? The only problem is tariffs get a hold. We have massive structural supply chain problems. Inflation shoots up. Interest rates shoot up now because that's the only antidote for inflation, right? So 3 out of 4 are beneficial to my trade. So when I have trades like that, I'm going like, I'm committed to it. I'm going to stick with it. I'm not going to change my mind. I don't see anything to change my mind. So that's it. That's what you do.
Yeah. So would you, like, if you see the bond market overnight, could you put on a put credit spread on the other side? If
Sure. Well, I can always get out of the short put. I can just go buy I'm the short 85 puts, right?
Yep.
I can only always go buy an 80 put, and then automatically becomes a put credit spread because I took in all the money, right?
Yep.
I'll just spend some of that money to protect myself because if I think TLT is going to 75, what's the point of me holding? It's like, doesn't make any sense. Right. I'll just go buy 80 puts and then just make it a put credit spread on the short side. There's always a way to fix these things. Worst comes to worst, I'll just get out of the whole thing. How about that?
Yeah, well.
I mean, but I think I'm giving myself enough time for this to work itself out, play itself out.
Yeah.
And 3 out of the 4 things are beneficial. And all I'm doing is tying up some money. I'm tying up money to bring in money that I'm not going to use anyway. Yeah. I wasn't going to have an imminent trade that I'm going to use. You know what I mean? So if I have putting up 20% of my 25% of my account into that trade, I still have 75% cash left. I'm like, well, what am I going to do with it?
So
I always have.
So are you going to do any NVIDIA trades next week?
Yeah, I'm pretty sure. Yeah.
Pretty sure. Okay.
Yeah.
What
I mean,
what
look,
do you think?
I trade infrequently, but when I do trade, I really do trade. Like it comes in like volumes. Because when I don't see a reason to do something, I'm not a junkie. I'm not gonna do it. But when I do see like you weren't a member then, about 2.5, 3 weeks ago. If you looked at go back and look at the community page. They're
Okay.
there. You see it full page of positions, right?
Right.
All kinds of synthetics and all kinds of short puts and long calls and all that shit. And I was like, okay, we're so close to a bottom here, irregardless of them delaying the tariffs. We were going to rally anyway because we're so stretched, so oversold that we just need a little bounce here. And that's what I do. I'll just see it fit, go shorter term, month out, sometimes week out, put these positions on, go to 70-80% commitment on the account, and then when the shit happens, scale in, scale out, and that's how you get to new all-time high in your equity. That's when I don't trade, don't get bored. I ain't gonna trade if I don't see anything happening. I'm not gonna be like, oh, I have to trade every day. No, I'm not one of those. Although I'm doing a lot more of zero DTE trading because I'm following Quant Data now. I have their subscription. I am honestly not sold either on that, because if you get caught with one of those, max loss can be hit like this on those. They're doing like nothing but iron condors, and I'm like, with this volatility, I'm not sure, man. Although it's 6 for 6 now, so I'm doing small, like 2, 3, 4 options at a time instead of my regular size. I'm like doing so small that it's just, it can't kill me kind of a thing. But like the day that Trump announced the delay in the tariffs, if you had a short call credit spread, your max loss like this.
Yeah.
And depends on your width of your wing, right? If your body is, let's say 5,000, 5,200, and we get to 5,400, your short side is like this, max loss, and you can't recover from that. So I'm like, I don't know. But
So are we like in this in between? I feel like just looking at the charts and looking like at Nvidia, all of them, like we're this.
yeah, we're in no man's land at the moment.
We have no man's land.
Yeah, for sure.
We're not at the bottom. Who knows if it goes up next week? Or
I honestly think market priced in a slowdown, and that's when the last low is. I think that low is going to hold for a while.
Okay.
But if the market decides to price it, if this silliness, this schoolyard bullshit goes on any longer, because I heard that Trump now put like some massive cost on per container coming in from China from the existing ships that are out there. I'm going like, we need to stop this. We just, this is too much. So look, the economy is a big economy. It moves slowly like a tanker, right?
Yep.
We're not going to know the effects of this for like 3 months, 6 months out. Okay. So all I'm seeing now is that low should hold 4,800 on SPX. That has priced in the slowdown. If we price in a recession, I think we're going down to 4,300, 4,200. That's going to be the next leg down. But at the moment, we tanked, we bounced, we crashed. Okay, let's not call it crashed. We bounced. We're rolling over kind of now. I think the low is going to hold for now. But another thing to watch is VIX. VIX went up to 60, pulled back to 30. Next time VIX is at 60, I guarantee you we'll be at a lower low. Okay, you got to watch all these things. And when like people get bored in the chat, in our group chat, bro, why do I need to trade when everything is in the middle of nowhere? I mean, I don't want to trade. What? I don't want to buy Nvidia. Now, if Nvidia goes to 90, maybe I'll give it a crack.
Yeah.
I mean,
or cracks below what 85 or whatever it was at.
Whatever. Or Tesla, it's like earnings coming out. I mean, I know you have a position, but I'm like,
Yeah.
if it goes to 160, if Tesla breaks 220, it's going to 160. There's no ifs and buts about it. Then I'll give it a shot. or I'll short it. I mean, whatever. All I'm saying is being bored and pressing and trying to make money is going to lose you money at times like this, because all it takes is one tweet. All your account is positioned correctly. Within the next hour, you're just blown out. I'm like, no, we're going to just stay slow, stay easy. But you'll see. You'll see when I start pressing. You guys will see that,
Yeah.
oh, okay, he's getting serious now. I'm like, yeah, but I'm not going to trade every day. No, hell no.
Yeah, I'm just being patient. I put that one trade on, but I mean, it was really
Yeah, man.
a low percentage. But I don't, I want to keep my
Yeah,
capital.
I agree. And, being involved at the time, risk reward, right? What's your risk? What's your reward?
Yeah,
I mean, you're taking a risk every day getting in your car and driving. Okay. Well, there's a reward to that, because 99 out of 100 times I'm going to get to where I need to get to. Well, in the market right now, risk reward is not there. Risk reward is there to like quick hit singles, like baseball analogy, right? Singles, hit singles, hit singles. Those will put a lot of runs together, and there will be a time to start swinging for the fences. It's not the time for that now. At least not for me anyway. But all I want to do is I want to stay plus 30-40% until maybe seasonality is good. Summertime's always good, right? All these things. Let these things play themselves out a little bit more. Let's see what's going to happen. It's never too late to sell. It's never too late to buy. But now I feel like there's this tornado cloud out there, and I'm like, is it going to come this way? Well, I don't want to find out. Let me get the heck out of the way. And then, there's always time. Patience, man. You got to be patient. So, but I will definitely add to my TLT. If it's like gets to 3.5 credit, I will add some more. I'm definitely, I don't see a reason not to. And I can fix it quickly. Like, I'll just go buy puts and done. No limited risk downside, 15x upside. Okay, fine. I can do that now. I can go buy an 80 put and I'm done.
yeah.
Not concerned. But I think it's going to work out beautifully. So that's it. So happy what is today? Happy
Good
Easter
Friday.
and happy Good Friday. Is that what it is? Good Friday. Yeah.
Good Friday. All right. Appreciate your time. Oh, by the way, sorry, I had to get off that day, but I
Oh,
had to
no,
leave.
no, no.
But
No problem. No
all right.
problem. But
Thanks again.
yeah, be well. Have a good weekend, and I'll see you guys on Monday. What's up, Macrobig? How's your baby? Collect 4% cash all day. Yeah. Yeah. That's what Warren Buffett is doing. That's what Mr. Buffett is doing. Liquid acid. Oh, acid. Yeah. Bitcoin, man. I think Bitcoin is going to take a next leg. So we need to be ready for MSTR, MSTU, IBIT, BITX. I like Bitcoin. But that's another time to discuss. Yes, Mojo, thank you. Happy Easter. See you later. Good morning, John. How was your fall last night? I hope it was good. Last but not least is my wife's birthday today, so I gotta go find some shit to buy. But anyway, so much love. Please share. Please put a thumbs up. If you decide to become a member group is growing. Email me, Sergio at sergioavadian.com. I'll send you the Telegram chat link. Only for members. And members, I do live streams every Wednesday. You're getting my experience and my knowledge for a Big Mac. I think it's a pretty good deal. So don't forget about this picture, people. Right here. This picture right here. Where is it? No, not that picture. This picture. Right here. Right here. There's the two kids. There's the two kids in a schoolyard. My dad's bigger than your dad. Hey, the other one goes, no, my dad's bigger than your dad. He's going to come kick your ass, kick your dad's ass. Meanwhile, who gets hurt? Not the kids. The dads will. Who are the dads? We the people, Chinese people, and the average American. We need to end this stupidity. I know nobody will watch this, but maybe you guys should forward this, or what do you call it? Yeah, share it. This needs to end. This is going to break some shit. We don't want to break some shit. We are the most powerful country on the planet, every which way. We have the best brains, best financial system. We don't need to fuck it up, people. We just don't need to. Let's just cooler head has to come together here. The silliness has gone long enough. So, yeah. Anyway, but much love. See you all on Monday, Trading with Sergio, and adios.